really went crazy this week. I had a buying power in my margin account of 90,000 Canadian, and right now I have a remaining buying power of 11,000. So I spent a big amount, which means I also borrowed about 77,000 from my margin account, which is very dangerous, very risky, not something I wanted to do. But to be honest, it just slowly happened. Every time I saw an opportunity, I felt like I had to take action, had to take it instead of feeling bad afterwards for not taking action. So I bought Six Flags this week because it dropped hard. I love it when stocks drop undeservingly. It went from 63 to 52.50, I believe. I bought it at 54. Reason being, of course, revenues are always growing, profits are always growing, maybe not quarter after quarter, but year after year, revenues are growing. I mean, if you look at the chart, it reminds me a lot of a Visa or MasterCard. So the past, since 2010, it's just been going up steadily. It pays 6% dividends. It's got a 1-year target price of 63. It's got a decent PE, price to earnings ratio. Their business model is great. They sell memberships and their memberships keep increasing, and even the restaurant memberships are increasing. And what's great about memberships is people pay for it, but they don't necessarily use it. So Six Flags collects the revenue, doesn't necessarily have to provide the service. And even if they do provide the service, it doesn't cost them much to provide the service because the equipment is already there. Whether people are sitting on the chairs or on the roller coasters or using the place, it's probably just going to cost more maintenance. But the business model makes it so that the more memberships they sell, the profitable they are, regardless of how often the members use the service. I mean, it's like a gym. I mean, a lot of people pay for memberships, but don't necessarily go to the gym, and they could go for a whole year without using the facilities, but paying that monthly subscription. So I bought Six Flags this week, 100 shares, of course, and sold. I had to do it, sold covered calls or sold call options at $1.50, but I sold the 55 strike price. So I felt like 54 was a low price. So I felt like the direction of the stock was to go back up. So I sold an out of the money strike price, not that much, just by $1. So I bought the stock at 54, but I sold the 55 strike price and I collected $150. So if by March 15, Six Flags is trading above $55, I'll keep my $1.50. And I'll also get an extra $1 from selling the shares. So that's about $250 on a 5,400 investment. So about 4% in 1 month. And I bought a bunch of other stocks. Bought AMD this week, collected $150. Morgan Stanley collected $103. Bristol Myers collected $228. JD.com collected $123. SNC Lavalin collected $145. Six Flags collected $150. So collected a lot of call premiums up front. So basically these call premiums, if everything goes to plan, is the potential profit I plan on making on these trades, but I collect them up front, and then I'll collect my investment at expiry date if the stock is trading above strike price. If not, then I'll keep the shares and I could potentially sell call options again the following month. But I am a little disappointed in myself for almost maxing out my margin account, very close to the limit, borrowing 77,000, which I think is of course a lot, and I'm going to be paying interest on that. So I better make sure that I'm making more than the 9% interest per year that Questrade charges me on the margin account. And on the TFSA side, I collected about $650 from the call premiums that I sold on IMGN. So I had a bunch of options expiring today. I did not buy any of them back because I don't like buying back options. If the stock is trading above my strike price, then my shares will get called away. But that's a strike price that I chose, so I have to accept that. So Bombardier went up like crazy on Thursday. It was trading at around $2 and it finished the week at around 2.6 or 2.7. So if we look at the stock price, I'm up $550. But I can't do anything with that 550 because I wrote covered calls on it. So the max I'm getting is, since I have a $2 strike price, I bought the stock at an average price of $195. When my shares get called away, they're gonna get called away at $2. But I've been collecting call premiums for 3 months on Bombardier, and so last month was 17 cents per share. So $170 that I collected just last month. So I'm still profitable, but obviously when the stock shoots up, that's the downside of writing covered calls, is that you miss out on potential upside. And in this case, it was a big time upside. So this one's going to get called away for sure. So on Monday, I'm going to have the cash. I didn't want to buy it back. CI Financial Corp is another one that went up like crazy from 17 to 19.33. So obviously I'm going to get called away because the strike price I chose was 17. This was, like I mentioned in my previous videos, this is a bad trade. I was still getting used to writing covered calls and I picked the wrong strike price. So I collected $80 from this trade, but $40 is going to go away in fees. So this is definitely a bad trade. Groupon. I got lucky with Groupon because it closed the day today at 3.49 and my strike price is 3.5. So I'm going to end up keeping the shares of Groupon. I didn't have to buy back the options and I get to keep the shares, and then next week I'm going to sell call options again. So if I look at the March 15 call option on Groupon or call premium on Groupon at 350, if I stick to the same strike price at 350, it's trading between 15 cents and 18 cents. So let's say 16 cents. So I'd collect next week 16 cents times 300 shares that I have minus the fees of $13. So I'd be collecting $35. It's not a lot, but percentage wise, take the $35 divided by my investment of, I bought it at 2.9 Groupon times 300 shares. So it's a 4% gain in 1 month. So that's probably what I'm going to do next week, is sell another call option on Groupon and collect another 4% in 1 month. I also have Macy's that expired worthless because I had chosen a $27 strike price and the stock closed at 24.88. So I'm going to keep the shares that I bought at 25.82. I'm down 3.5% on the shares, not a big deal. But last month I collected $86 from the call options and I get to do it again this month. So if you look at Macy's, if I were to sell call options again for the following month, so expiring March 15, I'd have to choose either go for the 26 strike price or the 27 strike price. So last month I went with 27. This month I'm probably going to go with 26. It's going to be closer to my purchase price of 25.82, but I don't mind having my shares get called away as long as I'm collecting the call premium, which is at least 3% per month. So if I'm able to sell or collect another $85 minus the $11 fees divided by my 25.82 investment, that's 2.8%. So that's not so great, but I can't go any lower than that. I can't go with the 25 strike price because of course I bought it at 25.82. And if I go 27, well, it's going to be less than 2.8%. But if Macy's rallies up and surpasses 27 by March 15, well, I'm going to collect a better capital gain, 27 minus 25.82. But so that's a decision I'll make next week, but most likely I'm going to go with the 26 strike price. Or what I could do is buy 100 more shares at whatever price Macy's is trading at, so that my return will be better, because instead of paying $11 in fees, I'll be paying $12, but I'll be collecting double the call premium. Plus my average purchase price of Macy's will be lower because I'll be buying it at around 24.8 instead of 25.8. So that's another possibility, is to buy more of the shares. But I do prefer to buy, if I'm going to buy more shares of a stock, it's usually if it drops at least by 10%. But buying back at the same price, I'm not sure if that's something I want to do. And in my TFSA, I have HBC that expired worthless. I had a strike price of 8. It closed at 7.73. So I keep the shares and I get to sell call options again the following week for 30 days, and I'll probably choose the same strike price of $8. Let's see what I can get from there. How many shares? I have 100 shares. So for March 15 at an $8 strike price, I'd collect around 17 or around 19 cents. So it's I probably wouldn't sell call premiums because it's very low, and with the fees it would come down to $10. So it's not worth it. So at this price, I wouldn't be selling call options against the HBC. So I just want to share with you guys how, so I think I'm going a little bit risky by almost maxing out my margin account or my buying power available. But at the same time, I mean, I did collect a bunch of call premiums this week. $150 plus $145 plus $123 plus $228 plus $103 plus $150, and most of them averaging about 3% on the investment in the shares. So we'll see what happens. This is exciting, but at the same time very, very dangerous. Although I am buying quality stock, so it's highly unlikely that that one of them just goes bankrupt. But it is possible that they all drop a little bit at the same time if the general market conditions are bad. So that's the risk I have, is being placed in a margin call and having to fund the account to recover any losses. So yeah, if you have any questions, leave them in the comment section below. Like always, if you're going to open an account with Questrade to trade on the stock market, use my referral code in the description below the video to get between $25 and $250 back, depending on your deposit. Also check out the other referral links in the description below the video to help support the channel. And it is tax season. If you're looking for an accountant to do your taxes, send me a message on my blog. Link is provided below. Don't forget to subscribe to the channel, share with your friends. Thanks for watching.